I'm clearly audible. Now, Professor Obek has also joined. So I welcome you, sir, again to this first lecture, and I welcome all the participants to this first lecture on of the course Gyan course Introduction to Mathematical Finance. The lecture title is Financial Market Models in Discrete Time and Space. So all the participants are requested to attend the lectures. Uh, Now I invite Professor Obek to deliver his lecture. So it is over to you, sir, now.
Thank you very much.
Yeah, you are
Sorry,
perfectly
can you?
audible. Yes, sir. Yes, sir. Please
Yes,
proceed.
but where's my video? Okay, okay. Now I see. Okay. So welcome everybody to this lecture on Introduction to Mathematical Finance. So in the first lecture, so we have several lectures. So the first lecture will be on the financial markets models in discrete time and space. And then we have a tutorial where we talk about financial market products. So mathematical finance is concerned with mathematics, but also, of course, with financial markets. So I will also introduce the basic concepts from financial markets like products, derivatives, and so on. That's mainly then done in the tutorial. So I urge you to participate actively because an online course is somewhat difficult to learn on an online course, I guess. So it's even more important that if you have a question, then you ask it during the lecture. Because also, I guess the audience is quite diverse. I start with some really basic concepts. But nevertheless, if you want a more detailed explanation or you didn't understand a single step, please ask during the lecture. No? So I will now
So,
try to.
sorry to interrupt you, sir. Yeah, so all the participants, they can unmute themselves and they can raise the doubts if they have
Yeah,
during the lecture. Yes. So they
yes,
can unmute themselves and they can ask.
yes.
So
So I would
everyone
be,
is requested to unmute himself if you have doubt and you can ask to professor. Thank you. You please
yeah,
continue, sir, now.
yeah. So let me now see. So I'm now. How do I talk from here? Turn on. So okay, I share now my screen. Just a second. So I will also show somehow the slides on another screen. Okay. But can I share? So I cannot share. Okay. Okay, I understand. Okay. Yeah. Just a second. Guillaume, I cannot share the other because I'm also online as Ludger Overbeck. In a
So
second.
are you not be able to share?
On the other one, so I can share only where I talk. That's probably true. I cannot share the other slides and talk on this device.
So
No.
just 1 minute. You can share from that other one also. Just 1 minute, sir.
Yeah.
So now, sir, you please try.
Yeah, now I can share. Okay, that's good.
Okay, thank you. Thank you. Yeah. Yeah, your screen is visible, sir.
Okay,
Yes.
very good, very good.
Yeah.
Okay.
Yeah.
Yes.
Yeah, it's perfectly
There's a
fine, sir.
question. Yeah, so that's good.
Yeah,
Okay.
it's perfectly fine. Yeah.
So that's basically the content. Yeah. So today we have our first lecture, and so that's at least my part of the course. So today we have the first lecture where we look at financial markets in discrete time and space. And so let me see. Yeah. And so here you see the further outline. So we have a tutorial after this where we talk about the basic products and the central non-arbitrage condition and arbitrage relation. And then my next lecture is on arbitrage theory and properties of complete markets. Yeah? So today we are basically working on one concrete example, and then in lecture 4 we will have a kind of a more abstract setting, more general setting. And for this we then need the theory of stochastic processes. So that's then kind of a part from probability theory, and we will apply it, and then we will see what the mathematical finance in discrete time will be. And then, because the the Black-Scholes formula is based on a continuous time model, in lecture 5 we will have our first steps in continuous time markets models. And then lecture 7 will be the most central lecture. That's option pricing in continuous time. And then we have stochastic calculus, and then we have that's somehow all the parts which we need in lecture 7, option pricing, continuous time. The theory behind this we will then have on lecture 8, stochastic calculus, which is more general, can be also applied outside mathematical finance with a general theory which is needed for understanding the Black-Scholes formula and related stuff. Okay. The main topic of the entire lecture is simple to value derivatives.
Sir, sorry to interrupt you. Can you
Yeah.
zoom it a bit? Can you zoom it a bit? Just using that plus sign in the above.
Okay, then I have to go in the other one. I can't do it in the full screen, but here I can zoom.
Yeah. Now you can just click on the plus. Yeah, that's it. Yeah. Now it's very, very good actually.
Okay. Okay. But how do you get rid of this one here? No. Okay. So this lecture is based on two books, mainly two monographies. That's from Shreve, Stochastic Calculus for Finance. That's a book which really works, which we later will also do concretely on the binomial tree. And for the more theoretical part, it's a book by Bingham and Kiesel. It's called Risk Neutral Pricing. So first, we have to think about what are financial instruments. Derivatives. Derivatives are financial instruments, and the name derivatives comes from the fact that the value is derived from the underlying financial instrument. So that's like the equities or bonds. And so the basic idea is at the end that the price of a derivative is just a function. This function we want to figure out of the underlying. Now, so derivative in this sense means it just derived from the value of the underlying. Yeah? And so this comes from the fact that the cash flow, a derivative is more or less a contract which defines certain cash flow at a given maturity. And this cash flow should only depend on the values of the underlying instrument. So this means derivative is a contract. That's why many lawyers are also working in investment banks. And the most classical example, and to some extent we will, if we don't specify something else, we will think about this type of derivatives, which is called a European call option. European call option. Of course, later you will see, of course, the European just also know, it's also an American call option, which we will see later, which is a more complex product. So this is the most simple option. And so that's a contract. Let's say the bank sells you a call option. This means then you have some rights. Then you are the owner of the call option. And if you are the owner of the call option, then you have the right to buy a fixed number of shares of a specific common stock at a fixed price at a given date. That's just a contract. It's a legal contract. It's binding for the bank. And you can then execute this contract at maturity. Usually the given date is called the strike time or maturity. That's denoted by capital T. The fixed price where you can buy the stock. So it's a option where you can buy. It's also that's a price that's called the strike level or strike price, and that's usually denoted by K. And so the third parameter in this contract is the number of shares, and so usually we take it n equals 1, assuming that if you buy 2, so you pay double the price. So prices are linear functionals on outcomes. So now the question is, how much do you want to pay for this option? Let's look at the specific one. So it's a value for you. Up. As an example, the common share, let's say that's a BioNTech, so it's a pharmaceutical company. Let's say you can buy the contract. The call option contract gives you the right to buy one BioNTech share in March next year at the price of 150. Let's say nowadays it's 160 or it's 140 or whatever it's today. It doesn't matter. Currently, for the contract, it doesn't matter. But just to explain the parameters, so the maturity is 3rd March 2026. Or you can just count the days. Usually it's a day count convention. So in real life, if you do it in a bank, it just counts the days until maturity. This should be roughly 150 days or something like this. And the strike level is 150. And usually, the underlying share, in this case a BioNTech share, but mathematically it's just a random variable S. And S with an index T is in the share price at time T. So what's only interested for us currently is, of course, only the strike time capital T. And then the mathematical formula for this cash like C or C like call option is a payout. It's a mathematical, it's a function of the final price ST. No? Namely, it's the maximum. No? So the cash, why do you write this as a cash flow? You can buy it at K from the contract and you make money. Usually you think your value, either you just keep it on your books, you buy it, let's say it was 300, then your gain at time capital T, even if you keep it on your books, then it's your valuation in your portfolio. But if you sell it immediately, if it's 300, you make a profit of 150. So that's the value of the call option at time t. It's just this mathematical function depending on the value of the underlying at time capital T. And then you can make this amount of money out of this. If it's 300, you have to buy it for 150. You sell it for 300 in the market. That's a market price, put it like this. So if you want to have an immediate profit, you make 150. Of course, if the option has just a value of 100, if ST is just 100, you don't have to buy it. That's the advantage of this contract. You don't have to buy the BioNTech share. Because if you would, then you make a loss. And the advantage of the option, you don't buy, you just say, okay, I don't want to have it, I don't buy it, I have no loss and no gain. So my CT is then 0. So this means that this option gives you a high gain if the price is higher than your strike price, and you have a low, and you have no loss and no gain if the actual price of the underlying S index T, in this case the BioNTech share price at end of March next year, if this is below 150, you don't do nothing. This is the option you have. That's the option to buy. You don't have to buy. So you can only make money. You will never lose money. But for this, you have to pay something today. The bank won't give it as a present to you. You have to pay money for this. And we want to figure out how much is reasonable to pay for an option like this. Okay. So this means this legal contract, it might be very complex actually, and there are also actually many mathematicians working in this area, had worked, especially in the credit crisis where the option payout was a very complex function of the underlying asset, to work out this function f from the contract. Okay, now this will be not part of our lecture, but in real life, sometimes it's not so easy to figure out, because it's written by lawyers. So you have to translate the lawyer's language in a function small f. In our case, f. In a call option case, f of x equals x minus k plus the positive part of x minus k. That's why it's also, because it depends on the underlying, they are also called contingent claims. More general, of course, it depends also. And so this more or less, this function f, which is the final payout, this you get from the contract. But what we want to figure out is at each time, especially at time t, let's say 0 today, we want to figure out the price of the option. No? Yeah, sometimes the option depends. You can you have at each time t, and that's what we want to figure out. Yeah, there's now another function which depends not the function f here, because it also depends on time and state. And this function we want to figure out. Ft of x is the value of the option before maturity, meaning t smaller, in capital T, and x, we want to plug in. It's the Vt itself. It's then also stochastic. It's also random variable, but the randomness only comes from the random variable value of the underlying stock at time t. Okay, it's clear. In order to be able to get a better understanding of this, to get a formula out of this, you have to know, or you have to analyze the potential values of the underlying share. And now a little example, this was the BioNTech share. So we have just in these notes, we have considered, let's say, two scenarios only. The one scenario, and this we call omega. I mean, I don't know how your background in probability theory is, but that's typically the in probability theory, of course, your probability space is a set capital omega and a sigma algebra F. Yeah, that's usually a measurable space. And now the economists, they always say omega, small omega element of capital omega, that's the state of the world or a future scenario. And depending on the state of the worlds, of the scenarios, of course, the value of the underlying share, in this our case, the BioNTech share is different. And of course, we have just considered the example omega equals just state of the world, where st of omega equals 300, and another one where it was 100, where the value was nothing, 0 at time capital T. So for our purpose, we just assume that's a countable space. Of course, in reality, or it's even a finite space, you have finitely many scenarios to get this. So this means currently from a mathematical point of view, F are just all subsets of omega. But in general, it's called a sigma field or sigma algebra. And so we assign probabilities to this. This means your probability space, you always have to work. That's why mathematical finance is basically a part of probability theory, because future is uncertain, so a mathematical tool to handle uncertainty is a probability space, and so you assign probabilities to subsets A of omega. But as I said, currently it's not of interest in the first lectures because we just say omega is a finite space, so sigma algebra is a set of all subsets, and we can assign to each subset, we assign the probability as a sum of all probabilities. Now, in this simple case, P of A equals the sum omega in A, P of small a, P of the set, the singleton P of omega, the set omega. But later it will become important, actually. Just to tell you, like, F is called information. And as it was done by some colleagues that, for example, mathematicians also work later in the regulatory framework. For example, perhaps you have heard of this, like insider trading. No? It's also a mathematical model for insider trading. An insider is a different a different sigma algebra than the market. And you can actually, one task of mathematician in the regulatory framework is to figure out whether you can see from the trading behavior of a participant whether he or she has insider information, meaning the information, the sigma algebra, the insider trader is trading on the information he or she has is different from the market information. It's a question of sigma algebra, actually, insider trading. Okay. Yeah. Okay. That's in our case, we have this simple model, and we will be more simple just to make clear the ideas. We have the binomial tree model. But basically, from this short introduction, you should have realized that we have two main problems: the modeling of the underlying,
Sir,
meaning,
sorry to interrupt you.
yeah,
I have one query. In the
yeah,
last slide, you discussed about this filtration and probability space. So, what is the good resource to read? Can you please tell the participants? I know it's present in by Stephen Shreve, but
yeah.
can you suggest something, some good resource to read all these concepts about sigma field and this probability space?
A
Any
general book on
book?
yeah. So I mean, so usually, of course, uh, yes, of
Stephen
course, we
Shreve
have.
has this content. Uh,
Yes, to some extent, yeah, it has it, but it's also like there are also, of course, books on probability theory, like Shirayev, yeah. So
okay,
Shirayev,
okay.
yeah, or
So,
probability theory, of course. And of course, we learn from German scholars writing English
okay,
books,
okay, okay.
and
Okay,
so Klenke. But I think that's okay. So I can. So that's my basic book. No, you don't see it. Okay, it's wrong. So it's Shirayev.
okay, sir. Thank you so much. Now you can proceed. So participants can note down this name and they can look into it if they wish. Yeah. Thank you so much, sir. Thank you.
Yeah. So, but that's measure theory. So it's like in our class, it is usually also taught like in infinities, like analysis 3 or something like this. Like in second year, you learn about this in this connection with the Lebesgue measure only. Yeah, usually it's based on all the theory. It's presented by people from analysis and differential geometry or whatever on P equal as a Lebesgue measure, but of course it also works for general probability measure.
Oh,
But it's
okay,
one
sir.
book. Yeah.
Yeah, yeah, yeah. Thank you, sir.
Okay.
You may proceed now. Yeah.
Yeah. But we will have a very simple model. Yeah? Okay, so we have this two main tasks, modeling of the underlying, which we will do as simplest one we have, the binomial model, where each time you have only two choices. And we will start with the one period model. We have only two times, namely the time today and the execution time or maturity time of the option. No? And so, of course, here we have to figure out the age is a value at time capital T. This we know. Yeah, but if we know the value of S at time capital T, we also know the value of the option, of the derivative. And so the basic idea, the main ideas are present already in this simple model. And that's what's called the no arbitrage principle. The no arbitrage principle tells you we won't construct a hedge portfolio, which we call also V, such that at maturity, at the second time when the option is executed, this portfolio, this means a portfolio, in this case it's simple, you buy as a banker, you get money from you as the owner, and you get money because at time capital T, the banker must also fulfill the contract. If you say, okay, I want now to sell for this low, buy for this low price, the bank must sell you the BioNTech share for this low price. So the bank makes a loss, and this loss is your gain. This means no arbitrage. There's no money disappears. So what the bank does, the bank constructs a hedge portfolio, which it's called V. And the condition on the hedge portfolio is in each of the scenarios, the value of the hedge portfolio should be the same as the value of the option. That's a no arbitrage principle, or you and that's a replication. That's what's called replication. Or hedge. Okay, now we have to construct the market. So this market, to make it simple, it has two traded securities. One is a bond like B, and we even assume that there's no interest rates. So the value of €1 in 1 year time, it's also one, whatever. Let's say dollar. Dollar is also one currency unit today will be also the value of this will be also 1 in 1 year. So no interest rate. And let's assume in this example, just to make it calculable, we have today the underlying share has value 10, and then we have to assign scenarios. And as I said, we have only 2 scenarios. Simple, it goes up. We have it here. It goes up to 20 with a probability P, and it goes down to 7.5 with probability 1 minus P. And you have bought today a call option with strike 15. This means if scenario 20, where the underlying make a gain of 5,
Sir, your mic
Sir,
is
your
mute.
mic is.
Uh,
okay.
yeah, now it's fine. Yeah.
Yeah.
Thank you.
So you have only these 2 scenarios, and now you want to build a hedge portfolio. So this means the value of the option at time 1, it's either 5 or it's 0. And now you want to build a hedge portfolio today. That's your today as a banker. You want to invest theta 1 into asset S, and you invest and you buy bonds theta 0. This means because capital B is always 1, your value of your portfolio is always theta 0 plus theta 1 times S. And so this task now of the replication is you want to figure out theta 0 and theta 1 such that the value at time 1 is the same as the option value. This means you have 2 equations and you have 2 unknowns. So it's very simple here.
Sir, one
Yes.
doubt, sir. Sir, the data which you have given up, I mean, that is preliminary data, I suppose, right, sir?
Excuse me?
That data, sir, that B of 0 and B of 1, which you have given a 0 investment. That data is already, I mean, that is preliminary data or how, sir?
No, you have to figure out theta 0 and theta 1. This you want to figure out.
Okay. No, no, the above
So,
data, sir,
so, so,
the one which you have.
yes, data are 20 and 7.5. These are data. Yeah, this you know. Somehow you know that as I said, you have finitely many states of S, which is of course unrealistic. Yeah, but even more unrealistic, you assume that there are only two states.
Yes, sir.
Yeah, so the uncertainty is only you don't know which of the state is taken.
Correct, sir. And the time period which I mentioned is only from 0 to 1, right, sir?
At time capital T, yeah, you only have two possibilities. Yeah.
In that particular interval 0 to 1, I suppose, no, sir?
P is in 0, 1. Yeah, that's true.
Yes, yes. Okay, okay.
Yeah, P is in 0, 1. Actually, you also don't know. This is the only one you don't know, but you will see you are not really interested in P. That's the funny thing about replication. You will,
Yes, sir. Yes.
yeah, you will later see that you're only interested in theta 0 and theta 1.
Okay, yes, sir.
And more or less for all P's, you get the same 0, 1 and 0, theta 0 and theta 1. This you see on this simple example already that P doesn't matter really.
Yeah,
That's
yes,
why
sir.
this is not, it was done in the introduction. We want to do prediction, but we don't do prediction in mathematical finance. We don't need to.
Yes, sir.
Of course,
Yes,
that's of course like in risk management with these techniques which you have developed in an arbitrage-free market. You don't need prediction for this purpose for pricing. Okay, but let's go through this example really step by step. It's good that you ask, because it looks simple, but the basic ideas are already in there. Okay,
yes.
this means you have now two scenarios. We call them up and down. In the up scenario, that's where the equity value 20 values 20, up, up. So this means S1 up equals 20. If it's going up to 20, and S1 down, it was 7.5. Now, this we know. We don't know the probability of up and down. But you have to solve these two equations. And once you are at this level, it's a simple linear equation for theta 0 and theta 1. This means, okay, what you should do as a banker, you sell more or less, or you have debts in the bond, and you buy 0.4 BioNTech shares. It's not BioNTech, it's just shares. Okay, here you see, okay, you need two properties of the market that you can buy a negative amount, which is called short selling. This means at time 1, your counterparty you have to deliver 3 bonds. Or 3, it's not bonds here, that like 3 currency units. And you have to buy today 0.4 shares. This means in theory what you need a market where you can buy arbitrary small or large amounts of and negative amounts of underlying assets. That's an assumption on the market you have in order to fulfill this mathematical, to solve this mathematical, to implement this mathematical solution. And you have only one solution. There is only one portfolio replicating the call option in each state, and it exactly the value of this today, this value we're interested in, that's a non-arbitrage principle. This means if something has the same value at year 1 or at a later point in time, it must have the same value today. That's what's called no arbitrage. Of course, we will see later a mathematical definition of this, but the idea is if you have something which has the same value in a future point in time, it must have the same value at every time before. Because if it's not the case, you buy it the cheaper, and later you buy the more expensive product by exchanging the one you have bought for a cheaper price. The non-arbitrage principle, it's important, tells you that any financial instrument which has the same value at year 1 must have the same value today. Because you can make money, but if they have the same value in year 1, you buy now the cheaper one, and you exchange it at the more expensive one in year 1. So this means this portfolio, which you construct as a banker, which gives you actually the same payout as the call option. The value of this portfolio today is just €1. And just by the replication argument, what you see importantly, P disappears. The probability going up, the probability of changing doesn't matter. Because as a banker, you can say, okay, independent whether it's going or up in both states, my portfolio gives me the same value. That's replication. And that's what's called, like the book I had, Bingham Kiesel, in the old time, it was risk neutral pricing, because there's no risk. Risk is neutralized by hedging. And that's the basic idea of hedging. And as you can see from this simple example, these are from mathematical finance, replication, and non-arbitrage. Of course, it's assumption, I told you. There are, of course, markets which have an arbitrage. Then you could buy something at different prices which will have same price in 1 year. But an arbitrage-free market, this is no arbitrage, forces you, shows that this €1 or one currency unit, that's a fair price of this call option in this market. Okay, we have done many assumptions, there are only 2 states, and we know actually the values of the states and so on. But we will proceed now and see, so that's like our single period binomial model. And to go further, direct you in the general theory, the interesting thing is that this one, so the price of the call option today, can be written as an expectation. It's just a reinterpretation of this value 1, that the expected value of the option, this was the option, or it's called C, option value, option payout at period 1, namely 5 and 0, you weight by the probability P star, and you get that the price of this call option is actually an expectation under a certain, a constructed, like not a statistical measure, but still an expectation under what's called the pricing measure, the risk-neutral measure, the arbitrage-free measure. Later we have these names, but basically the interpretation of the value as an expectation, that's a discount factor. I just put it in here for later reference. In our case, of course, it's 1. So in simples, everything is 1, which is not really important. Yeah. So, but important is here, you can write this option price, which is the value of the replicating portfolio, as an expectation under a certain specific probability measure, E star or P star, which in the binomial setting, just we have to figure out the probability of going up. The probability of going up is 20%. And if you think that's a probability, then the expectation of the payout of the option, that's the current price. Because prices are somehow expectation. And again, that's why it's not risk neutral. You might have an entire team of econometricians who specify the P without the star. That's your subjective assessment of the risk, whatever you like. But in reality, not in reality, in this Black-Scholes theory later, this does not depend on your statistical assessment of P, meaning of the probabilities that something happens. That's just the pricing probability. And so that's just fixed from the structure of the market in our, okay, it's very restrictive. I say it again, and this was also remarked before, noticed before, that you have a very simple probability space, just 2 states and one time. And if you go further in this, you see this P star has also a mathematical property. Namely, the asset price is a martingale. The asset price is a martingale. This means, if you recalculate it, the expectation E equals 1 of S1 equals S0. If you do the calculation, this we will later do in the tutorial, you see that it's a martingale. So in average, the discounted price, we don't discount because we have no interest rate, but you interpret, you can see that this price, and this will be transferred to more complex models. Pricing, price of an option is the expectation under the martingale measure, and the martingale measure is a probability measure, P star, such on average, the discounted asset prices don't change. Okay, now we become a little bit more formal. That's now you have a probability space. That's now your coin head. You have going up and down. So this is one important condition which looks harmless here. So this means going down. If it's going down, you earn less than the riskless interest rate, and it's going up, you earn more than in the riskless case, in the interest rate. Interest rate is somehow riskless. So there is somebody, usually it's the government, that at least government bond will pay the promised payout, your nominal back. So there's no, this means the market we are considering is currently, there's no credit risk, no credit risk on the bonds. The bonds are always paid according to the interest rate. Okay. And the contingent claim, that now more general, depends also on going head or tail. up or down, however you want to call it. Yeah? And then you have this investment, yeah, delta 0, yeah? And you want the hedge portfolio is this one. Yeah? And you can solve these equations. Yeah? This means these are the two equations in up like head. Yeah? The value of the option value in two states. This is discounting. It should be the same as the value of your hedge portfolio, which is this one. And you have to solve this one you want to figure out. Okay, that's what we have done before. Yeah? And so this you want to figure out, and you want to figure out this one. Because the V0, that's actually the price of the hedge portfolio. Yeah? That's just differently. Before we have called it theta 1. And this one we called theta 0, but that's a general formulation how you do it, because that's your initial values you need to know. That's the price. The V0 will be the price of the option. And because you write it like this, because if you want to abstract from this one, you already see the form of an integral, which you will see later. Okay, so here we do some calculus, and because we know already that we need this P star. Here you see there was no P, now we just introduced P star. And we solve this equation just by this trick with P star, and we get out the same. Here we get immediately that the starting value of your portfolio is also the discounted value under the probability P star. Here you already see the recursion, which you might get in the numeric. I don't know when we do the numerics. That's the recursion, how you go backwards. You know the values in future times. At maturity, you know the values. And you go back to the previous time. Of course, you can do it once, two, and so on. We just do, in a sense, in general numerical analysis, what we do now is the last step. We go from time end condition to one step before.
Excuse me, sir.
Yeah.
Sorry for the interruption, but I have a query.
Yeah,
Like,
please.
how do we guarantee that P star will exist?
That what exists? The
Sir, P star.
P star.
How do we? Yes, sir. For this scenario.
Yes, currently it's a kind in here. I mean, we have seen it before in the example I showed you. Now we do it abstractly. We now assume P star is a auxiliary variable we now introduce to solve this equation.
Yes, sir.
Yeah, we take the two equations we want to solve.
Yes,
and
sir.
what we do, we take a P star between 0 and 1 to determine later.
Yes, sir.
Currently, that's a numerical trick, put it like this. So how to solve an equation like this? We just now pull in mathematics or numerical analysis. We have two equations. Okay, usually you solve it by adding up them or whatever. Now, the first step, we weight them by P star.
Yes, sir.
yeah, and then add them up. Yeah? Because on the left-hand side, yeah, the V0, P star V0, 1 minus P star V0. Yeah, this one is what we have done here is P star V0 plus 1 minus P star V0. It's of course V0. This will be maintained because we want to know V0. Yeah? And so the left-hand side, P star comes from this one, Q star comes from this one. S0 is again, we sum up with the same. We just do calculus now, or numerics, however you want to call it. We want to solve 1.3 and 1.4. We multiply this by P star. We multiply this by minus P star. Right-hand side is here. Left-hand side is here. Okay, now we have a free parameter, namely P star. And now we say we want to have that this one is 0, because it's still free. That's now our this. If we choose, we have now free. We can choose however we want P star to put it like here.
Sir, if there is no P star exists, like if you have mentioned, like if you choose P star such that the
Yes,
factor multiplying delta
now
naught
we
equals to
get
0.
now we get a condition on P star, or put it like this on the other parameters, which we have already done.
Yes, sir.
So this, we need a condition on U and D and R, such that P star is in between 0 and 1. This was probably your question. Which condition? On the condition that this one is smaller than 1 and larger than 0. But this I said before. That's your gain on the bond. But the gain on the bond is larger, because this is the going up and going down. Down value, up value. I show you again. That's now our model. We ignore P, but that's our up value. So here's U, and here's down. That's a down value. And so your bond is interest rate.
Yes, sir.
Okay. Probably I didn't make it clear. I generalize it from before I had 20 and 7.5. Now I do everything in rates. So going up.
Sir, my query is that here it is written P star belongs to 0 to 1, such that. So if there is no P star belongs to 0, 1 and satisfy the condition mentioned.
Then you have an arbitrage. Very good question. So in this context, you actually figured out the main problem. If you put it like this, okay, when does P star exist?
Yes, sir.
You see, and so Very good question. You see, we go back. It's a question of probability of the properties of the markets. Sorry, I'm not used to online teaching anymore. Okay, here we stopped. But I did when I started with this. This is actually the condition. I just said, okay, going down. These are then your values. D S0 is smaller than S0, 1 plus R, smaller S0 of U. So that's your gain. It's actually a loss. If you invest S0, let's say, okay, that's 1.10. Let's say you have 10% interest to make it easy.
Yes, sir.
If you just invest €1, not in the asset, but in a bond, you will make 1.10. So if you know that D happens, you would never invest in a risky one. Because this one, let's say, under this condition must be then. And this must be U 1.20. U 1.2 and D 0.9. So this means in returns or in percentages, in a bad scenario, if you invest in a risky asset, will give you less return than the risk-less return. That's the risk-less, like the bond, as I said. Well, this doesn't happen because if you have bought S0, if you have bought the risky asset, you will either make a loss or you will make a gain. In order to be arbitrage-free, or as you pointed out, in order to get a P star, if it's going up, you should earn more than the riskless one. But if it's going down, you should earn less. Because if you always earn more on the risky asset, you will never invest in the riskless asset.
Okay, sir.
And all others, economically, an economist, and you also didn't ask here why you have this condition. I explained it economically or financially. But this is actually the condition. Under this condition, P star exists. So here you see really the, let's say, the intuitively or layman's understanding what is a reasonable markets, translate using these two equations in your question, when does P star exist?
Yes, sir.
And it exists if there is, under this condition, then we have a P star, and then we can do this numerics, which was in this motivation was just motivated by solving equations. And so this must be P star. Our condition was just because we were lazy, we want to have an easy solution to these two equations. We introduced the P star, and then we got rid of this term, and we immediately got V0 equals 1 over 1 plus R, P star, V1. We only have to figure out now P star. This means this should be 0, and we solve this to P star, and this is our solution. This P star makes this term 0. Can I do it like this? So this P star makes this term 0, solves this equation, and so we have a fast way, put it like this, to solve this equation by applying the P star, by introducing it from a theoretical point of view, probability theory point of view. If we can introduce a martingale measure P star, we can solve the hedge problem. And we can get the value of the hedge portfolio directly. And that's somehow another interesting thing here. We are now for, sorry. Again, so we had to solve this equation. We wanted to solve this equation. Our first goal was to get also delta 0. Our main goal is to get V0. That's the value of the replicating portfolio. We have solved this in these two equations by introducing P star, where we need condition on our probability space on the U and D's and on the R. If you like, on the market, if you like, but the probability you would see on your probability space, on the random variables you have. It takes only two values, U and D, and on the value of the riskless investment, namely in the bond, and R, so they should be related somehow and reasonable from an economic point of view. And then you get this P star, and you immediately get the V0 value, actually without knowing the replicating delta 0. This you don't know. This you get immediately once you have P star. P star does not depend on the replicating portfolio. But you get the value of the replicating portfolio without getting the delta 0. That's somehow also a feature of this, that you get value of the derivative without explicitly knowing yet the hedge portfolio itself. But the value you know, but not the hedge ratio, as it's called, the delta 0, you don't know. You don't need to know in order to get the value of the asset by a replication argument in an arbitrage-free market. You get the value of the replicating portfolio by this martingale measure, by this P star. But actually, you don't need to know delta 0. So if you are lazy, you just sell as a banker, and that is a problem of risk management at the end. You just say the price is V0, but as a banker, if you are lazy, to calculate delta 0 is too complicated for me. I don't do it. I know it's, let's say in the previous example, it's €1, so give me €1. But if I don't do nothing, it might be that the model has changed in between. Or the model is wrong anyway. You see, it's also interesting to see that the value V0 you got without knowing delta 0, just by this P star trick. But of course, then you can calculate, and you should calculate also your hedge ratio delta 0. Hedge ratio. It's called usual hedge. If you have heard of this, it's the hedge ratio. Okay. So here you see it. That's your hedge rate. Then you solve by delta 0. You get also from 1.4 and 1.3, you get also delta 0. Also, 1.4. These are these two equations. You now know 1.3, 1.4. These are these two equations. You subtract them. V0 is cancelled. Here's the 1 over 1 plus R, D1H minus D1T. You solve for delta 0. And you see easily that delta 0. Once you know V0, No? Even if you don't know V0, you also don't know delta 0. No? And we should have also done it the other way around, just do delta 0, solve for delta 0. That's what we have done in the first simple example. We solved for delta 0 directly. No? So we get delta 0. Okay. In this term, you can also write it like this. The delta 0 is value of that's your hedge amount. If you ask, actually, most bankers would do it the same way. They would say, okay, I take the change of the financial instrument and divide it by the change of the underlying. Let me write it like this. So it's a derivative. It's also a mathematical. So the hedge ratio of a derivative is a mathematical derivative. You see the derivative here? So it's delta of the, call it now C, because there's too many deltas of the option, divided by delta S. Now it's a discrete derivative. If you want to think in terms of continuous time, assume that h to t, that's a change in one, h to t, that's more or less delta t. That's a change which goes over time. So this one, anyway, this one is a derivative, and we will later see in this simple 2 points derivatives are they are both derivatives to high head and tails, up and down. What's the difference? What's the difference in the underlying underlying asset? And you compare it. If this change appears in the underlying asset, what is this change appearing in the call price? But of course, you don't know the call price. But at time one, you just know it. Okay. So from this simple example, our takeaways is we are pricing by replication. The replication cost, or the value of replicating portfolio, that's the expectation under the martingale measure. And so it's interesting that just if you come from, let's say, numerical analysis, just this simple trick, this already tells you, discount the future value, this equals expectation star of V1 discounted as before, or 1 over 1 plus R. So just this you can, we have motivated it before differently, but here just by solving this equation, you already see that your value of a portfolio is always expectation under the risk neutral measure of the discounted value. And this H1 in our case is actually then the value of the derivative. Okay, now this we do now in multiple steps. That's what's called the binomial tree model. Here we now have many time points, and each time point, if we're going up, in the next time step, we can go up and down. And so this we go several times. So this means we extend this single triangle to a binomial tree. And each time we go up and down, not yet specifying the probabilities, but the underlying probability space is now this one. You're going up. I mean, it's visually up. There's usually each head, put it like this, or up, however you call it. Next time you can go up again, and so on. So that's the underlying probability space, looks like this, where you can decode it, visualize it like this binomial tree. Here you have a Bernoulli random variable, and here you have, let's say, success is going up. You can go twice up or once up and twice down, and so on. This has a binomial distribution. The value of the underlying does not depend whether it's going down, up, down. It's again an assumption on the underlying probability. But nevertheless, so if you look at these values, then you get a binomial distribution with parameter p. And at each time, what we have done, if you like, before we had considered actually this one. Let's say we have s equals 3. We have in very much detail analyzed this one. Not the conditional probabilities, now p. And that's one way of thinking about filtration. If we know the value of at time 2, if we know the value at time 3, we can figure out by going backwards the value at time 2. Before it didn't matter whether we had 0, 1, it's just one step backward. And we got V0, and here we got V2, of course, in 3 different states. And then you go backward. And there are several arguments for this. One is this numerical one is just a replication one, and the other one, the most mathematical one, is the one with the okay, you then have the values. If you like, you start with a value of €, and you have A times U square. So these are the values, if you like. But it's the same. The underlying probabilistic structure in this simple example is a binomial tree. It's for many purposes, like also numerical purposes. I mean, later, if you do a numerical implementation, you also, I guess, in one of the tutorials, you might implement a tree like this. And the reason, and then you go through this tree backwards. What we have done in one step with several arguments, just for numerical purposes. And later you will see that actually a discrete approximation to what's called the Black-Scholes partial differential equation. Where it's connection to partial differential equation. You get one way of solving certain types of partial differential equation. Also three methods. What you see here also from a mathematical finance point of view. So that's a binomial tree. And so let's see, yes, we have 2 periods just to make it one example. 3 steps. 2 steps only. So the picture was for 3 steps. Now we take 2 steps only. And just to make it clear that the option might be complex, like this one. The general one might depend on whether you're going up, up. This is up, up, head, head. Up, down, down, up, up, up. Well, I don't know whether you have financed your house, for example, your home, mortgages. Sometimes you can say, okay, you go to a bank, you just don't know when you want to get the money, but you want to have the cheapest interest over the next year.
Yeah, sir. Yeah.
Yeah, you can have a contract which is then path dependent. Yeah, you want to get a mortgage for your house, but you probably build it in half a year. But now the interests are low and even might become lower. You want to have the lowest interest over the next half year, and then you want to lend money for this low interest. But for this, you have to pay a fee. It's also an option fee now. That's path dependent.
Yeah, sir. Yes.
Yeah. But still, you can do the same argument as we have done before. Each time, next time she also does an investment, which we call delta 1. But of course, the hedger can only invest the money she has. Yeah. At N1, that's the value at the beginning. That's now the value at V1. At time 1, the value of the hedge portfolio is V1. And now, for the next step, she wants to reshuffle this money. Yeah, that's called self-financing. She decides to do delta 1 in the risky asset, but because she only has V1, she will invest V1 minus the amount, the cost of the hedge in the risky asset. That's the value we now do the second step. She has the hedger has V1, buys this one, this she spends for investment in the risky asset. So the remaining money, she keeps at money, which is comes into the riskless asset. If it's negative, it's a bond, and so on. And then the wealth at the next time step is V2 equals delta 1, what she invested before, sigma 2 V1 minus. Because it's a new value, it's the value when she invested, and that's a new value at time 2. And that's the investment increased by the riskless interest rate, the investment in the money. If it's 10% interest rate, she has 10% gain on the money. Now we have to solve 4 equations. But of course, these are separated equations. This is, you see, this one is one step. You come from H and you go up and down. You come from T and you go up and down. There are 2 separated equations. You solve as before. Basically, you are in the binomial tree on this level. But we argue here not by the numerics. We argue just by investments. We are now here. You want to know your hedges. You have this triangle as before, and you have this triangle. And you solve the equations accordingly. This was scenario is head, and this was S T. Okay, so you have to solve this equation, and now you see already the recursion which appears here. In each time delta 1 T. This you want to figure out. You have 2 equations for delta 1 T and 2 equations for delta 1. So you get the same. You get always the delta 1. It's always a discrete derivative, if you like, mathematical derivative, and so on. Okay. So this means if you go through this, stop. You have these equations. Yeah, that's your assumption. No, this was a question you were asked, which was asked at the beginning. Your assumptions on your probability space, or the underlying asset. Yeah, so you have going down. The return by going down is less than the riskless one, but in the going up in the second state, you have more gain than in the riskless investment. Again, this one, risky up, risky down, riskless. And you need exactly this condition in order to get your risk-neutral probability P star, your martingale probability is P star, and then we define the risk-neutral value backward in time. That's now the value of the option by, this is kind of E star, the delta N. If you are familiar with mathematical, with probability, which we will see later. So that's a martingale probability. That's a definition. We define it as a martingale, as an expectation. So an average at time n, the value of everything is discounted the same as one time step later. And at delta capital T, you know the payout. That's how you run through the, and the delta hedge amount is then the delta, that's dc ds, delta hedge. And then, if you construct it like this at each point in time, especially at time maturity, your payout of your value, replicating portfolio, at maturity equals option payout. And that's your final goal. The price of the option is the same as the replicating portfolio, because the replicating portfolio actually at each point in time, by definition more or less, has the same value, because by no arbitrage condition, if this is fulfilled, then at each point, time and point before, it should have also the same value. It's a replicating. And so that's, as you see, there's, except my interpretation, here there's no probability involved, except the condition that P star exists. And that's a condition on the arbitrage, that there's no arbitrage in the market, which is reasonable in a risky world. If you're unlucky, you should lose actually something. And if you're lucky, you gain more than in just keeping the money in your hands. Riskless investment.
Excuse me, sir. Sir, one more is that, sir, in binomial tree, as you shown in the diagram, it consider only two cases, like either it go up or it go down.
Yes, it's a very restrictive probability space. You are correct. So it's a probability.
But sir, what if there is a third possibility, like at some moment the price will not move?
Yes, of course, you can also do it for other, and then the hedge ratios become more complex. Huh? So there's also, you have a trinomial tree, yeah, for some product, like for interest rate. If the interest rate is also random, you need a trinomial, yeah, if you have different values. Yeah. So this one is actually for the market, no? Where you have each point in time, you can move up or down. I mean, of course, you can have, I mean, if you think a little bit about the formulas, you can, of course, have everything time dependent. You can make it a little bit more complex by just saying at each point in time, you have a different D. D depends on small t, R depends on small t, and U depends on small t. But at each time, it must fulfill this one. You can put here, if you like, t, 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 which makes it a little bit more complex, but the same idea holds. You can make 3 equations, but then you need more hedge ratio, more uncertainty. As I said, so if your interest rate is also uncertain, you need a trinomial tree. But put it like this, to some extent, okay, that's a numerical implement. That's also heading for a numerical interpretation. But basically, from a theoretical point of view, what we will do is take this random walk. This is a random walk going up and down.
Yes, sir.
Yeah, and the random walk limit, if it's going all small up and down faster, but then you get a Brownian motion, or a geometric Brownian motion, because these are returns.
Yes, sir.
So that's the standard Black-Scholes model, assumes that the asset price, here we have our asset price, S0 goes up, that's a single path, now down, up, down. And this will converge to a Brownian motion.
Yes, sir.
This will, so we have more and more time points. So this will be our goal. Of course, you can also look at other discrete time models, where we will also have a short overview. But then the conditions on this P star becomes, of course, also more involved. You have P1, P2, P3, and you need a martingale, that this becomes a martingale. So it's basically, people use this continuous time models, and you will see it, and then you derive PDEs, and they are solved by tree methods, and I don't know, also by finite difference schemes, and so finite difference schemes.
That I will be discussing. Yes, sir. That finite difference scheme I'll be discussing today.
And tree models are another way to solve PDEs. And then you can use, but then you don't need these arbitrage arguments. So this is just, this lecture is more like a more or less a theory-free introduction to Brownian motions, if you like. What we will see later. And I think time is over now for the first lecture.
Yes, sir, time is over. You may continue in your next lecture, which is scheduled after 1.5 hours. So next lecture is scheduled at 11 a.m. German time and 2:30 p.m. Indian time. So all the participants are requested to join at 2:30 p.m. Sir will continue his topic, and I'm winding